Okay, good evening, ladies and gentlemen. This is Clueless Trading Frank. This is a very important end of the week and pre next week webinar market update, and we'll be going over a bunch of stuff to get people prepared on what's coming for next week. Very, very important week coming up. Today is the 23rd of April 2017, approximately 7:27 p.m. Eastern Standard Time. Full disclosure, this session is designed for financial education and not for any solicitation or advice. As I always say, it's MYOT. You got to manage your own trades. I will provide all the helpful and the necessary strategic tools for everyone to do what they need to do. And of course, personal responsibility and decision making is what is going to be the key to your own success or failure. And we'll move on from here. I thank you all for coming in. It's a very important evening. This beautiful evening here on the East Coast, and what's happening in Paris, in France, not just in Paris. With a very pivotal first round of elections. I've been posting some very important tweets and posts because these things are extremely critical. I know many of you are not really tuned in with what's really is happening overseas, but in the globalized world that we live in, we have to be extremely cognizant about what is happening across our shores, whether it be in Europe, whether it be in Asia, whether it be in the East, in South Asia, primarily, and of course these things are extremely important. I'd like to do a quick roll call to make sure that everyone has audio-visual contact so we can go over this webinar in a more effective manner. We have KBot, we have Exita, good to see you. We have Fish Eyes. We have a good old friend who's been extremely busy lately, from what I know, Casey Novak. We have Ripping Pants. We have Scott, and we have Sweet, which I'm not sure who Sweet is. I forgot actually. And we have Swimming the Market. Some of you might not have a headset, but do keep in mind that that's important for the Q&A part of the session. And I will be opening up a good portion of this webinar to answer any questions that you all might have, and try to answer as intelligently as possible to the best of my knowledge. So, first of all, there are multiple screens here in the back. Just want to make sure that all of you are seeing the audio, are listening to the audio and seeing the visuals behind you on the screen. So if I may ask, can all of you just say yes or type in that you are, that you do have access to both the audio and the visual, please, before I continue.
Yeah.
Oui.
Okay.
Yes.
That's good. And Sweet, what's I know that the person, I think in one of the webinars, whose handle is Sweet, by the way? Oh, okay, it's KBot. Okay, because you are also under your actual name, so I wasn't sure. Okay, that's great. So let me just start off this webinar by going back to the basics a bit. I'm not going to go through this exercise on technical pattern analysis, but many of you who are taking the advanced coaching sessions and focusing and what should I say, having the passion to learn a little bit more and allowing me to dive in deep with my experience and my limited knowledge that I have in what I do in this world of financial trading and U.S. markets, know very well that this what you're looking at in the back, this is obviously from Google, that this pattern analysis and technical patterns, which constantly keep on repeating itself in rapid fashion, is of critical importance. So I highly suggest that you copy and paste, and I'm doing that right now in the actual member chat room, and also here on the GoToMeeting on the GoToMeeting chat box, that you go ahead and save this on your computers, so that at any given time when you're completely bored out of your mind, I highly suggest that you look at these things at least once a week or whenever you want, to familiarize your brain, I should say your eyes, and train your eyes to talk to your brain. And there are multiple resources here, and just looking at these images alone will help you in your daily and weekly and monthly activities in looking at my charts and seeing that the same patterns are repeated over and over and over again in many different forms that I put across on my tactical charts that I produce for all your benefit. So highly suggested that you save this and review it once in a while, because without really understanding, there you go, without really understanding the technical patterns and all these different forms, shapes, and sizes that occur in the market on a daily basis, whether it be candlesticks here, whether it be ascending triangles, symmetrical triangles, wedges, falling wedges, descending flags, rectangles, flags and pennants, and all this different stuff, which might seem somewhat fictional to people who are not really used to it, but extremely productive and material to us who make a living, or try to make a living, I should say, of technical patterns and market forms. These are of extreme critical importance. Head and Shoulders, some people might think it's the name of a nice shampoo, you know, you buy it, Duane Reade. Inverse Head and Shoulders, whatever the case may be, extremely powerful patterns that constantly repeat themselves. And some of the charts that we're going to look at today, and to remind yourselves, all the content that's produced and posted for your review on the real-time Twitter feed are replicating these patterns all the time. So whether you're a believer in technical analysis or not, it really doesn't matter, because it is something that is there to stay. It is something that you cannot run away from. There's an old saying for people who are hardcore technical believers, and again, I'm somewhat in the middle. I believe that in order to be successful in the business, you have to apply technicals, you have to apply fundamentals, you have to apply behavioral finance, mix it in all together, apply a nice dose of luck and knowledge on what some of the macroeconomic and political factors and what their implications are on the markets, whether it be US, domestic, or international. That technicals precede fundamentals. That's an old saying. The technicals always come before the fundamental news hits the markets. And you know what? It's true. So highly suggest, again, I know I'm repeating myself, that you all go ahead and take a look at these things. And more you look at it and the more you see it occur over and over again on my charts, on my trades, you start to become a believer. And then if you make money off it, then you become a real believer. Because no one is a believer till they hit some home runs. It's just the way it is. Right? Bottom Head and Shoulders, all kinds of stuff. And I'm just clicking through some of them so you know what I'm talking about. This one looks like a lot on a lot of my charts. Fibonacci retracements, this and this, you know, at 0. what the retracements could be. This is Aussie dollar versus Japanese yen. This is really for foreign exchange traders. Here's one which is really a cup and handle pattern. Lots of zigzags. Very similar to what we are going to talk about right now. All right. So again, that's it. So I'm going to move the screen out of here. Make sure that you copy and paste this particular resource, which is simply a simple search on Google, and tons and tons. This is the Gartley pattern. Of course, this is in currency markets. It doesn't matter. It's the same technical stuff. And what might seem to the naked eye, untrained eye, as something bad is actually just the opposite. You can see that. Hundreds and hundreds of images. Like this one. This is a real, this is really speaking the truth. Research has proven that some chart patterns have high forecasting probabilities. As I've always said, trading, investing is not a game of certainties. There are no guarantees in life or in trading, but it's a game of high probabilities. If you think there's a good probability of the risk reward being favorable to your side, then obviously you want to take that trade. And if you think it's the opposite chart wise, then it's not your side. I mean, it's not something worth taking. So saying all that, behind you, you're looking at actual E-mini futures here, which are occurring right now. The E-minis right now are at session highs, gapping up about 22 points. We're going to go over this in a minute. So let me just make a couple of comments before we dive in. And I believe these comments are going to be useful to all of you, and I suggest that you guys listen carefully. What we are encountering in the markets, which we have encountered before, but more so right now from these levels, are extremely volatile markets. No question about it. These are not the type of markets that are meant to be just sat back and saying, oh, everything's just going to work out, no problem. Futures are up 22. I knew the market was going up. You're going to hear that a lot of this garbage from other sides, from different forums and things. Nobody knows. Okay? And I suggested that we would go long based on many of the factors that we look at. But at the same time, there was no guarantee whatsoever. Let's face facts here. Clueless trading is designed not to provide, excuse my French, bullshit. It is designed to provide factual, statistical probabilities on the upside or downside. So if you're looking to hear a long-winded BS story on why it was guaranteed, well, you're not going to get it here. Number two, extremely difficult markets, extremely volatile markets that I will admit has thrown off many, many people, including myself at times. The only way that you remain calm, the only way, this is a beautiful example of a chart that I've been showing for weeks now. This is where we are. This is where I had projected for the markets to be. So very difficult markets. So don't blame yourself if you panicked or did some stupid stuff. But my question is, in life and in trading, how many times can we keep on doing stupid stuff? We all do stupid things in life. Okay? As long as it's not intentional, it's fine. If it's unintentional, you tried and you failed, it's okay. That's a learning experience. Failures are learning experiences. Repeated stupidity is not a learning experience. Repeated stupidity means that you deserve to be punished and left in the dungeon. Okay, that's the bottom line. But if you make all the right decisions based on tactical charts, based on a conviction on what's going on, at least you tried. So don't take it the wrong way. Don't get dejected. Don't get rejected by the markets, and don't feel that your confidence is completely eroded because you did the right thing but it didn't work out. That's your mental calibration that you need to go in with. Number three, if you do not take even limited risk in the market, you are never going to get the reward. How can you make 22 points on the S&P 500 gap open, which might not be 21, 22 points at the open, but I believe it's going to be pretty, even if it's half up, futures up 10 up, you're still going to make out damn well right at the open tomorrow morning at 9:30 a.m. unless something changes. Anything can happen, but I'm giving you from what we are seeing at hand right now. I can't predict what's going to happen overnight with the North Korean fat man dictator. Maybe he tests the underground nuclear test. Maybe our Navy goes and bombs one of their underground facilities through one of those bunker buster bombs. Then futures are going to be down 21 before they move again higher. So we don't know that. But I'm just saying that unless you take that limited risk, you're never going to get anywhere. So that's just a fact of life. That's just a fact of trading. And I see a lot of traders, good people who just don't want to take any risk whatsoever. In that case, what's the point of trading? Don't trade. Don't be a trader. Just don't do it. And I'm not saying this to lose members. I'm just saying it as a helpful suggestion. Just, you're not meant to be there. Number 4, we are dealing with a market which is being whipsawed on a structured basis, and we're still hitting some pretty serious home runs because we are focusing on really deep, in-depth technical patterns and what the risk reward could be. And but we're dealing with a very volatile, very structured volatile market on a daily basis. Futures open up, people start chasing at the top end of the thing. For example, here it doesn't break out, pulls back, they blame the alerts, they blame anything that they can find their hands on, but the point is you got to blame yourself, because the point of entry would be here on this reversal candle. We're going to talk about this tonight because the charts are there. You can't run away from it. I can't run away from what I post out there. I can't take it back and delete a tactical chart and say, oops, sorry, I didn't mean to put it there after the fact. After the fact traders, excuse my French, are complete bullshitters. Okay? You can't come in after the fact and say, oh, this thing's up 30, I owned it there. No. Where's the alert that you put out there to tell us, whether it's a member sharing trades or whether it's me? All my stuff is out there. I'm held accountable to, hey, you said it didn't work. Okay. So the bottom line is that got to be in it to win it. The final point that I want to make is that going forward, we are going to be hit with major volatility. And we have been hit with major volatility, whether it be coming out of the White House, on tax reform, on healthcare reform, on a tweet that is unintended by good old, Donald Trump, our president, or whether it's some stupidity caused by something else overseas. We just get used to it. There's no running away from it. There's no running away from it. So if you don't embrace volatility, just give up trading. And I'm giving you a very helpful suggestion because this is not meant for you. Trading's not meant for everyone. It's just not meant for it. This is a very strategic business. This is like being a general in a war where you're drawing out plans and you have to adapt and be flexible as you move along the battlefield, and the battlefield being the market. All right? So I don't want to preach, but I just want to give this to you because many of you don't quite understand that this is not a cakewalk, through Disney World. So saying all that, let's take a look at one of the most important charts here and try and explain what is going on. Let me get my drawing tool. Okay, so good color. So this is a chart that I've been working off, one of the charts that I've been working off. And do keep in mind that I use multiple platforms. This is investing.com. This is investing.com. I use Thinkorswim, the one you were looking at before. I use freestockcharts.com. I haven't been, that's Warden. I haven't been using it that much. And this is where we are right now, just in case you guys haven't focused your eyes yet. Investing.com, I'm sorry, freestockcharts.com. That's provided by Warden, great chart platform. And most importantly, I use Quodd, the Quodd, QUODD, what I call the Algo HFT platform, which seems to pick up data from dark pools and other sources because they're extremely precise. So multiple chart platforms will give me multiple views of the same thing. I on a constant basis on the background, use roughly 30 to 40 different indicators that I'm following before I'm posting anything, before I'm making any sort of rational judgment to put out a rational decision to put out my tweets. Every one of my tweets that I post out there, whether on individual stocks or on markets, are based on a decision-making process and not just on a whim. I try not to be held hostage to my emotions or your emotions. I try to be as robotic as possible, and God willing, as time goes on, I will be more robotic as time goes on. Without my unemotional bias towards the market on a daily basis, I believe that many of you would be lost in the maze of complete confusion. Because if I'm going to be the content provider and the so-called driver of this bus at Clueless A Trading, I better not be emotional, because then you'll be basically rolling off the cliff every single day. So let's take a look at this here. So here's a chart that I drew, and this was on Friday afternoon. If you notice what I put out there, I basically put out there that, and again, I know I keep on repeating myself, but what can I say? That's the most critical ingredient for all of you. If you don't review my charts, then you don't know what the heck I'm talking about. And there are some good traders in our group who just don't review my charts. It's okay. You know, some of you might think I'm complaining and stuff, but honestly, I really don't care. Excuse me, I'm just having my coffee. So bottom line is that I said long tail hammer reversals bullish. This was the biggest long tail hammer reversal that occurred at approximately around 1 o'clock. And I believe that that was a very pivotal reversal off the drop. And one of the reasons the hammer reversal occurred, because the news broke that by Wednesday or so, we would have some sort of idea about the tax reform proposals, and that we would have some sort of healthcare bill, not necessarily passed, but some good news about it. And the market basically reversed. These were the two candles at the close, which I didn't give too much prominence to, for a simple reason, that they did not engulf the body of this hammer reversal. What does that mean? Simple English. Simple English means that this was the length of the hammer reversal. If the body of this candle completely engulfed or went below that hammer reversal, then we would have a good, strong possibility. And remember, this is technical. This is before the French first round of elections and all that stuff. Would be right here. And I'm going to show you what the probabilities could have been. Not what is going on exactly right now, but the probabilities could have been if things went the other way. So these long tail hammer reversals, the structure that you're looking at, and I'll open this up for Q&A in a bit. The structure, the large structure that you're looking at, that I've constantly talked about, which I called a very complex head and shoulder with multiple shoulders here. Okay, that's a left shoulder, left shoulder, left shoulder. This big drop here, and we caught a good portion of this move when people were panicking. They're just panicking. I mean, they were just falling off, you know, because you hear always the same things in the room, and there's nothing wrong with that. That, oh, the close in the market, you know, it's horrible. There's 1 200 million MOC or market on close. In other words, there are that many shares to be sold by some institutions. Honestly speaking, it does not mean a hill of beans whatsoever. What a fund is doing at the end of the day, many of you might know this, some of you who are really, kind of in tune with the market, is large-scale ETFs, exchange-traded funds, balancing their books at the end of the day between 3:50 and 4 p.m. So the MOCs, 200 million to buy, 200 million to sell, really does not matter. Now, if you have some billion plus to sell, yeah, you're going to get a nice thud at the end of the day. They're going to push the market a little bit down. But I rely on my charts, not the data that's being fed out of the New York Stock Exchange. Whatever the case, you have a big, major support, big head here, multiple pullbacks, which are holding, give or take, the same head and shoulder, the shoulders. And if somebody doesn't understand the basics of a inverse head and shoulder, this is an inverse head and shoulder, 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 shoulder. That's a bullish pattern. So I'm going to call it BL. How about that, just for short? This is and that's your neckline. This is a very, very simple pattern. Complicated when it's actually playing out in the markets. This is a head. This is a bearish. I'm going to say bear. Okay, this is a bearish pattern, the head and shoulders pattern, and that's also being played out in the markets on certain, on a certain time frame, where you have a left shoulder, a right shoulder, a neckline which breaks, and then you go further down. This is just the opposite of that. So you got to memorize these patterns, and it's not that hard, believe me. You guys in your careers you've memorized far more difficult things. So here you have a head, and you got the left shoulder. I'm going to call it L. You got a right shoulder. I'm going to call RR. This is complex, right? It's not as clean cut as this. Then you have this big fat move, which we caught a good portion of. You've caught bunches of these pullbacks too when we go short through SPX puts to UVXY and such. You guys know that. But the market is still on a longer term basis, which we'll look at the other charts, is on a bullish upside pattern, uptrend. So whatever you short, you can be putting a majority of your money on the short side, because this market is not ready to break yet, a real break. And as I was explaining to one of the advanced coaching session students this morning and yesterday, there is no real big break or break, up or down. It's just a lot of small ones that happen all the time. So if you're waiting for Armageddon, well, let me just tell you, by the time Armageddon arrives, the only time Armageddon arrives is when we're dead. And you don't need a technical chart to figure that out, okay? So when you're dead, you don't know what the heck's going on. So that's the thing. When they're saying, oh, the market's going to fall 2,000 points, well, it doesn't do that in one day. And if there is a black swan event to that degree, which does that, well, you won't know, because we'll probably be dead. Like a nuclear strike out of North Korea. I mean, seriously. So don't wait for those big, oh, it's going to be a huge thing down or a huge thing up. Just play what we are forecasting within the smaller ups and downs. So this large scale pattern of going back to it, what we call IHS, inverted or inverse head and shoulders, is exactly what's in play. So I put this long tail hammer reversals bullish. I found it to be bullish. I knew what my downside was. If things didn't go the right way, I would have support here at around 23.36. Now keep in mind, this is the E-minis. These are the futures, the real driver behind the stage of the market, right? As you all know, the E-mini futures you have to add 5 to whatever number you're looking at. So if the futures are which closed at 23.43 or so on Friday, that means the SPX closed at, you just add 5 to it, SPX closed around 23.48, somewhere around there. All right, and you can verify that on your end. So that's how you do it, okay? These are not the exact S&P. You got to add 5 or roughly 5 points to it. Simple stuff, but don't get messed around because every point counts. So I said these are long tail hammer reversals. This pattern is intact. Here was my downside projections that if things did go wrong. I had a strong support here because this was the last level of the big breakout right there, which was on the 20th, which was on a Thursday. If you all remember, when those SPX calls went completely berserk higher. Okay, so that's one support. The next level of support comes in at these shoulders. Pure technical analysis, the right shoulder, the next level of support would have been at this shoulder, which would be around 2330. Once you know what your downside is, you don't need to panic. You don't need to really like go dead quiet and just, oh my God, you know, go for the dull diapers or like, oh, this is the end of the world and all that garbage. Try to remain as sane and calm as possible. Because without that, you can't do much. You can't, you won't be able to make any money to meet your responsibility that you have. Well, I don't need to tell you that, okay? So bottom line is, that's your next level of support, 2330. If this broke, and we would have a major, this is the major support level I'm putting as S, or the head, right here, the head of that inverse head and shoulder at 2320 or 2322. Now this could have happened. The markets are like the fact that there's a stalemate with a slight edge towards the centrist market-friendly French contender, Macron, his name, right? Markets are about money. So they kind of like that. Le Pen, even if she, let's say, for example, she had a big lead and she won the first round of the elections today with a wide lead, I could assure you that we would be at these supports right now. Instead of being up 20, 22 points on the E-minis or the futures, we would be down 20, 22 points initially. There's a fundamental difference between the conservative, the serious right-wing conservative candidate, Marine Le Pen, and Donald Trump and the Republican Party in the U.S. I'm sure maybe some of you know. I know most of you don't know. Marine Le Pen's policies, if you really dissect it, are extremely socialist. Extremely socialist. Lots of welfare for the French economy. Lots of free handouts. Of course, very nationalistic tendencies, anti-immigration, get the heck out of the European Union. All that stuff is standard. We know that. But the economic policies, if you really want to look into it, and if some of you are really into that, well, that's pretty commendable, is not what a true Republican, conservative, political leader, what we know from our side, is what Marine Le Pen is. She's basically a socialist in a very right-wing, anti-immigrant nationalist movement. And France has enough problems for her to have her popularity. I'm not getting into the political stuff here. Okay? So she's not good for the markets, period. I don't care what your overall emotional tendencies are about her overall, political policies, because most of you don't know. And I'm not insulting anyone, it's a fact. So she would be terrible for the markets. But the markets have a way of forcing people leaders to get back on track. If the French economy took a big thud on a big win on her part, which, by the way, the elections haven't ended. May 7th is the next round. She might lead forward. So that's another date to watch out for, first week of May. And like I say, after the first 5 or 7 days of a new month, you better be lowering your exposure to the long positions in the market. And that also happens to be May 7th. So bottom line is that that's the case. All right? So without getting too much in the French political system or so, if she had won, by a large majority the first round of elections today, we'd be down here. So all possibilities are there. And at this point, I could assure you, we would get an immediate bounce in the markets towards this support, 2330, or to retest this extremely powerful, big fat red line. Like they say, don't cross the red lines, right? Red line, except this is a real red line, downtrend line. So it's possible that we would have fallen here, come up to test support right there. Remember, these are robots working, not your head, not your emotions. Maybe fail, test again. If we broke 2320, then we're talking about some serious downside down to about the 2300 level, if not lower. We're going to look at that on the other chart. Or we could have bounced further, retested the downtrend line, which has acted as major resistance quite a few times. It's gotten close to it here. Hit it. I called it. That things were getting a little bit frothy. It looked like it was going to go higher towards this level. This was back last week. And but it didn't. Hit that wall, created this, allowed me to draw this downtrend line in a more confirmed basis. And that downtrend line was retested and followed through with a big fat, big powerful, not a fat, but a big powerful reversal candle known as a long tail hammer, which is bullish, and some selling right at the end of the day, just to confuse the living daylights out of every single human and retail trader that's out there, including many of our members. So we would hit that here, downtrend line again, possibly fail, possibly not. Market did want to go up, then we would basically get towards the upper end of this move here, which would be this consolidation channel at around 2346. What would that pattern look like if you drew it? It would look like this, which in reality, if you drew a straight line, sorry, looks like a W pattern if you really want to see what it looks like. Let me just, without making a mess, let's draw this right. There. Okay? A W pattern or a dragon bullish. That would be the case. But let's face where we are right now. So where we are right now is that didn't happen. Macron has a small lead. It's a runoff election. Markets know better. They, the European markets know a heck of a lot better what's going on in France than we do. And instead, we basically made a big move up here. That move is not something out of the ordinary. If you look at the channels that have been drawn and presented for your eyes to talk to your brain repeatedly, and do allow your eyes to talk to your brain more often than not, instead of just listening to me, then you would know that I had drawn these channels, which are very clear. The upper end of this channel is roughly 2373. This is an extremely critical level right there before this big fat flash crash. So you draw a line here. I think I had a line here. I don't know why it disappeared. Right there. So where we are right now is right in that zone. Right in that zone. So it's not any magic to me that when I wake up tomorrow morning to see where we are, if we pull back, we have a major resistance here, which is now support. Right there, right there. Why is that? Because that was the last major supply point, or supply zone, as we call it, where the market sold off. Right there. So that is right here. So futures could pull back 4 points. We're up 20. It's very possible before the session ends, we're going to be up 16, which means we would be right here. Why? Because right there. This resistance will be support. Futures traders who bought in smart money, or whoever it was, the robots who faked us, and I didn't fake me, but faked many of you and others out there. I'm sure a lot of traders out there on StockTwits and other forums were all going short because the end of the world was near. The bottom line is the smart money or whatever that bought here, They have a 20+ point gain right now as we speak in the Globex futures markets. That's a lottery ticket. It's like a scratch off and you just got paid some big fat ticket, whether it be 10,000, 20,000, 100,000, I don't know, whatever. So there we are. So this is the channel that we are working on right now. Upper end of the channel is here. I can assure you that right at this 2375 level, which is roughly around 2380 or so, which I've repeatedly shown as the upper end of the SPX in almost all my charts, is the point where the retail trader is going to get, or the human trader is going to feel the most excited. Because the chasers tomorrow at this market will be chasing the market at this zone. I think that's pretty dangerous. And I think people on my service know that very well, because I'm not showing the internals down here, but those internals are going to be severely overbought. Now, yes, we can go higher. We're going to take a look at that. We're going to look at the upside stuff. But. Think about it for a minute. You don't buy down here, which is a great risk-reward thing, alerts putting out there, and you want to chase the market up here, and then, you see it in our room too. Lots of wowzers, lots of excitement. Well, no, that's the sell zone in my book, or at least the immediate sell zone. You gap open 20 points. What do? Chase the market for another 20 points? Yeah, you can after it pulls back a little bit, maybe towards the lower end of the channel, but not immediately. Yeah, I could be wrong. Markets could open up 100 points and then run up another 100, but that's more of a low probability move. But this is where the euphoria comes in. What do? You sell euphoria, you buy despair. At this point, it was all despair Friday afternoon. I feel it. I see it. I read traders like an open book. So bottom line is, this would be the sell zone. This is not a buy zone till it starts to show some sort of big breakout or whatever the case may be. So let's look to see what the upside could be. The upside is basically, these are the highs in the market. 2393 means we're getting towards that 2400 level on the S&P 500. Right? So bottom line is that if we look at this here, these channels are giving you volumes of information on how you need to manage your trades. I would rather be a buyer here on the pullback after selling here or wherever it opens. Maybe it opens here. Because remember one thing, there's a good amount of shorts in the market. Institutional shorts, many cases, who just can't get away from the fact that they just cannot believe that this market can go higher. They can't believe that Donald J. Trump can actually move the U.S. economy forward. They're just all haters. So their haters, their hating translates into shorting the market every time it moves higher. And then comes Mnuchin, then comes Tillerson, then comes, these big fantastic minds in the Donald Trump team who say the right things, who are doing the right things, and they just keep on saying, no, they can't do it. They're just lying. No, they're not lying. They are people who want to do what is right for the country and economically will help and benefit things. All right? So bottom line is, the upper end of the move is this channel. And can that happen? Sure, it can happen. What's the time frame? Can happen as by end of next week, by the end of the month. That means testing the highs in the market. But let's not go there yet. This 23 level, this is a massive resistance level. There will be selling here. There will be selling. Not crash selling, just selling. So if we open up, let's say it's futures are up about 1975 right now. They were up 22. Doesn't really matter. There's a little profit taking going on. You can see that there. So bottom line is that if it gets up here, you better sell that heck out. And of course, I'm constantly there to engage with my members. And more importantly, I'm putting out the tweets. If I'm starting to see a lot of internals and stuff that I'm looking at in all my different platforms, I'm going to say short the market. Is it possible that we have a crash like this? Because right now what's happening is this massive move here down is being replicated right here. So let me just get this out. Get a different color so people can be a little bit more engaged. This pattern symmetry is exactly what got played out right now. Now, some of you have seen this happen over and over and over again, i.e. pattern symmetry completion. And some of you who are newer, or some of you who are too stubborn or skeptical, just don't believe it. But it happens because human behavior and algo behavior don't change. Algos are designed on mathematical probabilities. That's why my charts are so precise. Not because I'm a genius, it's because I know how to read these machines better than anybody out there, or most people out there. So this pattern just almost got, there's a little room here, almost got completed. When you get pattern completion to this magnitude, you do not want to go hog wild on I'm talking overall market here. I'm not talking individual stocks. You don't want to go overall hog wild and start chasing the market. You want to see where it settles. Does it come to the lower end of the channel? Does it come and test this massive support now, which was previous resistance? We'll see. But what I projected and forecasted based on this very large inverse head and shoulder, I take full credit for it now that it worked. At this moment, at 8:12 p.m. Eastern Standard Time on April 23rd. And if it holds tomorrow morning. Okay? So, let's put it this way. Scott just put a thing, unemployment rate for the young is crazy high in France. Yeah, it is. It is. It's way high. Never compare European economies to us. Just don't, because they're totally different structures. France is a great country, great minds. If you look at history, they have invented more things back in those days, 1600s, 1700s than we even did. So, but they got some major issues. They're basically a socialist country trying to be capitalist, all right? So it's a process they need to move forward fast. So Le Pen, or almost all their leaders, they better get their act straight, right? Because they're all about welfare, and welfare doesn't work. So that's it. So that's where we are. Now let's take a look at, so this chart, keep on tracking it. I'm putting it through. Now when you look at it, you'll know what I'm talking about. You got channels, you got the Bollinger. Well, right now it's a pinch Bollinger with some profit taking going on. The levels, extremely important. And this very zigzag patterns. This type of volatility, very few can trade. We do here at Clueless Day Trading. And that is a massive feat. No question about it. Embrace volatility. So let me get this out. Now, let's take a look at the actual futures. I've been showing this chart, and this is the same chart as the previous one, but it looks a little bit different, right? It looks more like glitzy, more Star Wars style, right? It's Think or Swim. So bottom line is that if you look at the channels where we are, look where we are. We almost got on the actual futures to 23.75. We went as high as 23.72.79 in the past 20 minutes or since 6 o'clock. There's your big fat downtrend line. Right there. Can we come back and test this 23.56? Absolutely we can. It can happen when we wake up and we'll be like, hey, we were up 20. Now we're only up 6-7 points. What happened? Well, nothing happened. It's just the way technicals work. The news simply pushes along the technicals. So then we broke through this, and this is where we are. This is the 1 hour chart. Let's take a look at the daily. And there's a bunch of stuff happening on the daily, and I'm going to pull in the S&P 500 here. And something very, very critical that I've been showing for the last 5 days. Can somebody tell me what it is? Can somebody step up and tell me what it is? I know you guys know. So what was one of the very important technical patterns? I shouldn't say pattern, but a technical measure that I posted 5 days ago. And I said this would work out based on what would happen on certain days. What is it? No, Scott, it's not a high or low. You got to focus a little bit more. I'm serious. It's called the follow-through day. It's staring at you guys. Okay, please. It's called the follow-through day. I've been talking about this for a whole bunch of days now, and I even wrote it down. Yes, you're right, Scott. It's a higher low, but anybody can say it's a higher low. That's not the reason why you're at Clueless Day Trading. You got to think a little bit outside, especially when I'm guiding you towards it. So don't take me the wrong way. I got to be a coach. I can't pander to this, you know, to that kind of simple answer. Don't take me the wrong way. Well, I don't need to apologize for that because it's nothing to do about the wrong way. So what I talked about was the follow-through day. So this was something chart that I've shown repeatedly, and some of you got it. Many of you got it. So this was the big drop, and I put it out there that after that big drop, I even put the explanation of that. This is a term that was coined by William O'Neill, the founder of, one of the founders of technical analysis, the founder of Investors Business Daily, right? With William O'Neill, the what do you call the CAN-SLIM method. Anyway, so the fourth day. So it's the day 1, day 2, day 3, day 4, and I said day 4, which is known as the real follow-through day, is the day the market has to go higher. And guess what? The market went up 207 points and ended up 170 points. That's serious precision forecasting. If that follow-through day didn't work, we'd be in deep trouble. Le Pen or no Le Pen. All right? So the higher lows are just a consequence of that. But that's not, I'm talking about the actual definition of the technical term. But I asked this question and none of you answered, which is unbelievable. Scott at least tried. It's pretty good, it's pretty amazing. I'm actually, that's kind of funny. I mean, ask an intelligent question. I mean, give me an unintelligent answer. I don't care. But at least that's how you learn. So the 5th day was Friday. There are a couple of things happening here on this chart which all of you have to understand. Number 1, you got a follow-through day going on. Okay? 4th day was way high. And then you got the 5th day on Friday, which was this red candle within the body of this large green candle, follow-through candle. So this body of this candle is engulfed within the body of this green candle, known as an inside day, because it's inside the body of the candle. Want really specific definitions? Please go to Investopedia, Google it, learn it on your own. I kept on saying one of the most critical measures, the second critical measure, was we are attacking the 50-day moving average. The 50-day moving average is right now, intersecting with the slightly downward sloping 34-day moving average at 2357 and change. We need to get above the 50-day. Well, we already did. Futures up 20. We're above the 50-day, ladies and gentlemen. And when I show you the futures chart, you can see the corresponding move because that's live. This is static. This is not reflecting what's happening right now in the Globex markets on the S&P 500. So the 50-day, very critical. What's also happening is focus on this yellow line here. And I've talked about this before, and it's a reminder. This is the 5-day moving average, the 5-day SMA, 5-day simple moving average. The 5-day simple moving average, when you look at the curvature of this, it is curving up. Despite this big thump back on the 21st of March, 22nd of March, 24th of March, and then this big fat reversal, we had lost on the 27th of March, we had lost the 50-day moving average again. And at that time I said too, they will defend this 50-day SMA. It's a very critical thing. Traditional technical analyst, whatever, the 50-day is something that has to be defended in a uptrending market. Repeated failures of the 50-day moving average means that we are going to be going down slowly but surely over the next following weeks. And maybe that's going to happen. We don't know. The bottom line is we went in, and what happened to the 5-day? It started to change direction. That's exactly what is happening right now. This doesn't mean we're going to the moon or we're going to make a new high. It simply means that we have 2380 on the S&P 500. We are right now, if you adjust it, we are at 2372 or 2373 on the S&P 500, which means we are here right now, right there in this zone, right now, if you adjust it for the futures, right there. So the most you can get up to is 2380, and you got some big fat, then you complete this pattern. And you got some big fat supply, big fat resistance. That's why you have these red arrows here, posted for your benefit. If we break out over that, yeah, we're going to take out some new highs. And the previous high was around 2401 on the S&P. So yeah, it's possible, you know, we get up there. And it's very possible we can get up there. But this is going to be major, you know, with a lot of selling's going to come in. That's pretty standard. So we've done that. So follow through, change in the short-term direction on the 5-day SMA. Keep in mind that despite all this volatility in the market, big moves up, big moves down. If you notice, the 50-day moving average is still curving higher. Still curving higher. The 34-day moving average is starting to curve lower. Can everyone see that? Yes or no? Yes? Yes? Okay, good. Because that's very critical, what I'm going to say right now. This is starting to curve lower. And it has acted as resistance several times. You can see here, acted as resistance once, twice, thrice, 4 times, and 5th time on Friday. Now we are up here. Okay? So what's happening is if the 50-day keeps on moving higher and the 34-day, this orange line, keeps on moving, crossing over, at one point it's going to cross down. Now, just because it crosses down doesn't necessarily mean it's the end of the world. It simply means that it is markets are going to, from a predictive basis, the markets are going to go lower. Now, I know that's a little bit too much. I don't really care what happened in the market 10 days from now. I just want my stocks to work in the next 20 minutes. Honestly, that's fine. That's what traders do. You want to make your loot and take it down on a daily basis or, you know, day trade. Because there's no, you know, it's not like markets are way too volatile. Some people are day trading. That's fine. Some swing trades you can hold, but don't hold overnight positions too large. Even though we're up 20 points, if somebody lost their head, I don't have that much overnight. A decent amount to feel good on Monday morning, as I alerted, but not like the whole kit and caboodle is all thrown on the table. What if futures were down 20? You'd be done. You'll be fried in the brain. So anyway, if the 34 and the 50 cross down, then you would start to see and it kept on crossing down. This one kept on crossing down. Let's say over the next couple of weeks. Then the 50, which is rising, still rising, this red line would start to basically get pressured down. That would be the start of a multi-week correction in between 100, 200 point snapback days and stuff, but that would be the start of a multi-week correction. But let's leave it where it is right now, and I'll alert you guys when I start to see that. Remember, these things are great to see after the fact. This is the only service which will probably show you before the fact what might happen. Because after the fact, everyone, oh yeah, I knew that was going to happen. That's all garbage. Traders are the best liars. And the worst part is that traders lie to themselves. When traders lie to themselves, it only hurts them. Justification of your faults and denial of your faults, and I'm talking to myself too, believe me. Okay? Denial and justification of your faults and your deficiencies is the worst thing you could ever do. Keep on telling yourself, oh, well, yeah, I should have done that. Oh, yeah, it's no big deal. Those are the worst things ever. You will never make the real money. That is a guarantee I can give you. You got to get angry at yourself. You got to challenge yourself. It's just like any other thing. It's just like sports. It's just like any other business. You got to get mad at yourself. Only then can you excel. Blaming others, blaming the content provided on the service, blaming the world, blaming this, blaming that is not going to do anything for anybody. And a lot of traders do that. Please shed that habit. It's called a no excuse routine. No excuses, move forward, do what is necessary. Even if you fail, you tried, you learned something from it. That's the essence of grit. That's the essence of success. And I don't need to be Tony Robbins here. So saying all that, technically speaking, this is a major fat resistance. Now, another thing that kept me going, like this market does want to go above the 50 SMA, even though the fact that you read enough articles out there saying, oh, we lost a 50-day, it's all over, is this simple indicator known as the full stochastics. The stochastics were crossing over. You don't need to be a rocket scientist to figure that out. You can see that it bottomed here, and it's starting to cross over. So despite the intermittent intraday volatility, you could see that this wanted to go higher. Now, by the time it gets up here, it's really simple. That means the markets are overbought. Markets are overbought. Look. It exactly falls within a range of 1 to 2 days when markets get overbought. Look. There, I had a minor correction, came down, turned. Look. What can I say? Just follow that. So that's another indicator that told me that we were going to basically power higher regardless of the noise that's in the market. Okay, so let's do some projecting what might happen. We have a couple, this chart is pretty fantastic, so I'm going to go back a little bit. I think I drew it very nicely. There. Okay, so you got the follow-through days. This is the 5th day. Here's the other thing about the follow-through days. Day 4 to 7, which brings us into, remember, day 5 was Friday. Day 6 will be Monday. Day 7 will be Tuesday. By the 7th, which is Wednesday, we could be extreme overbought at that 2380 level. Just keep that in mind. And Wednesdays generally are corrective pullback days. As I'm going to be learning and stuff, you better take down some long exposure on the fast-moving names, the Teslas, the Amazons, the Googles, and that type of stuff. Not talking about the swing trades we're sitting on by Wednesday. And Wednesday also happens to be, they're going to announce the tax reform package. They're going to announce the healthcare, whatever they're trying to do. And guess what? The markets might be a little bit disappointed. Because what I'm reading in between the lines, in many different pieces that I look at over the weekend, that they're not going to be that specific on the exact tax reform proposal. They're going to be putting out some broad guidelines. Well, if the market's already gone up on that rumor and they're expecting some massive concrete proposals and it doesn't come, what do you think the market's going to do? They're going to pull back. And that's all being shown here. By the time we reach 2380, it's pullback time, in my opinion. Or we could bust a move and go to 2400, but I think 2380 is going to be very powerful resistance. So saying all that, I have some channels drawn here. Upper end of the channel, which should be extremely bullish, is 2441. Wow, that's big. Can somebody tell me from 2348, where we closed at, roughly 2348, up to 2443, that's roughly 90 points. What adjusted, how much is that's on the Dow Jones Industrial Average? Somebody please volunteer, because this is really, really important. If we gain 90 points on the S&P 500, let's say over the next couple of weeks, all right, this is not a one-day event, this move up here towards the upper end of this acceleration channel. This is this acceleration channel I'm talking about. And gain about 90 S&P points. Roughly how much will that be on, somebody's already answered, but how much will that be on the Dow Jones Industrial Average? So if somebody doesn't know, just keep in mind, it's every S&P point is roughly, and I've said this a lot of times, and you should know this. This is as much as knowing, like when you take out a dollar bill from your wallet, that it's a $1 bill. You know that in your head, right? Like blindly. Well, you should know this blindly too. One S&P point is roughly 5 Dow points, 5 or 6. Okay, so 90 S&P points, which would be this big monster move up to the lower end of the channel, is roughly 450 Dow points. If we get 450 Dow points, where would be the Dow Jones Industrial Average right now? Thank you, Rip. Okay? Rip's like ripping, man. Simple stuff. Yeah, we'd be back at 22,000. We would be back at 20. We would be back, not back at 22,000. We were at 21,000. No, we wouldn't be 22,000. Right now, the Dow Jones average, you're wrong, Rip. I'm sorry. I'll take that. 21,000. Yeah. You got me there, man. You got me there. Yeah, I'm like 22,000. Wow, we're talking some real business here. I'm like calibrating my head. No, we'd be back at 21,000 plus. All right, 450 points from here, or maybe overshoot a little bit. So that's kind of this uber bullish scenario. Otherwise, we got a major support at 2,320 and a possible strong support here. And please keep this in the back of your head as we move forward. Right there. Right there. 2,300. Why? Because that's not only a round number, that's exactly where we broke out of on the 9th of February when nobody expected it. And it ripped the heads out of the bears to a point that was very painful for a lot of large institutional hedge funds who were short, because that was billions of dollars that they had to basically suffer, short squeeze as we call it, and it's not nice. All right? So, but that 2,300 level, in my opinion, will get tested, and that's probably going to happen in May. All right? And it's not much. If we fall from 2,348, where we are right now, down to 2,300, that's 48 points. Aside from Rip, can somebody tell me 48 S&P points, how much drop on the Dow Jones it is? Please. If we lose 48 S&P points and test the 2,300 level, which was the breakout level, which would be another screaming buy, how much is that on the Dow Jones? Please, can somebody just say it? Thank you, Scott. Scott just typed it in. And thanks for the others who didn't volunteer. Can nobody hear me, or I'm just curious? Can people hear me, or am I disconnected? Yes? No?
We hear you.
Okay, great. Okay, great. All right. Thank you, Scott. So 240 points. So are we going to all freak out and panic and jump out the first floor window? I wouldn't recommend anyone jumping anywhere aside from the first floor. Do not jump off the second floor window. You might get really hurt. Okay, all kidding aside. So if you do panic and jump off, either jump off your chair or the first floor window. Seriously, okay? So are we going to all panic and jump off like the first floor window or the chair if we drop 240 points? No. In fact, it'll be really, really, really healthy. Individual stocks will get smacked, so you got to be, you got to manage your positions. And I'll certainly be there to put out some very timely alerts. But 240 points from here, now we are here, by the way. So it's going to be more than 240 points. But from Friday's close would be great. That would create, in my opinion, a very powerful, now we're here, what if we drop here, powerful buying position within this trading range, large trading range between 2,300 and 2,380, and possibly create another dragon bullish W formation. It'd be great. So be ready for it. Don't freak out. And if you do freak out, like I said, jump off a low chair. All right? All right. So let's move on. So it's pretty clear. So these charts are extremely precise. These channels that you're looking at, these are really bearish channels. If things really go wrong, and good old Donald, my boy from New York City, does not deliver on corporate tax reform after August, we're going to see these channels come into play. This was the election rally, ladies and gentlemen. The one that after 2 days, within a day after elections, I said, that's it. They're going to rip this market, kingdom come. And they did. Higher. Okay? So this, ladies and gentlemen, was Donald Trump winning 800 points Dow, after hours, open down lower with the inverted hammer, and then see you later. Right? See you later. Well, in between some large corrective moves. If it does not deliver, remember, you can like somebody as much as you want, but liking and getting something delivered, which is concrete for the U.S. economy, for U.S. corporations, tax repatriation, tax cuts for corporations, bank deregulations, all that stuff, Dodd-Frank being kind of minimized, the extreme regulations that were put on the banks and stuff after the 2007, 2008 crisis, then believe me when I tell you, you will retest this level quite fast because the markets will lose patience. And it's not all going to be like, oh yeah, I like Donald and I love Melania, and I'm just going to keep on believing. No. The markets will lose their belief. That's just the way it works in business. Because there's a lot been promised. So if you don't deliver half of that or more than half of that, you are going to get punished. And the markets have a beautiful way of punishing whoever's in power, Democrats or Republicans, if they don't deliver. End of story. Can this happen? Sure, it can happen. When? Well, if they don't deliver and stuff, this is going to happen by September. And if you'd like to know how much that is, do the math. That's 400 points from where we are, 300 points from where we are to here, roughly. We're at 2380 right now, 2370, 300 points. Can somebody tell me what 300 points is on the S&P 500, on the Dow Jones Industrial Average? Please. I'm waiting. Okay, K-Bot stepped up. It's basically 1,500 to 1,800 points. It's not going to feel good if you have your eyes closed and keep, and the train is falling off the cliff, and you're like, no, I'm not going off the cliff. Obviously, I'm not going to be doing that. Okay, so this 1,800 points, roughly 1,500 to 1,800 points, this whole rally will be given back. That's the uber bearish view. But we shall see. I don't think that's going to happen. They will deliver. Okay? And that's why we're going to be stuck in this range. That's it. That's your forecast for that. So that's your picture on that side. Looking at the same on the S&P 500, that's the same chart, but here is the S&P 500 from election time. Let's draw these lines out, remove all drawings. Look what's going on. Remember, this is where we are right now. It just happens to be exactly almost at major resistance that I've been talking about for a while. And all happened in the course of one evening on a lovely Sunday evening right now, with majority of traders not positioned right whatsoever. A lot of them short. That means they are dead on arrival. Hate saying that, but that's exactly what it is in the trading world. On Monday morning, and then the rest of the lemmings are chasing. Remember, lemmings are basically late chasers. Sometimes sweepers, sometimes just late chasers. You start chasing the market at this level, at this major resistance, in my opinion, like somebody got, don't take me the wrong way, that's really stupid. I mean, really stupid. And I'm a bull. That doesn't mean I'm a blind bull. We're getting overbought. By the time we get overbought here, which I believe is going to be at this level, which is on the S&P 500, roughly 2390, or possibly testing the highs at 2401. 2401. By that time, ladies and gentlemen, this picture is going to look like this, just like that. Now, if we bust a move over here, then that means this is a big, fat breakout. But we're not there yet. So I'm not going to sit here and say it's going to do that. All right? So, but once we get overbought, My internals are going to tell me, and this is the simplest one you guys can use, all of you, is going to tell me that it's time to basically short the market or reduce long exposure substantially. So that's your actual E-minis, dynamic E-minis that we're looking at real time right now. Here's your election, then we collapsed. We were down to 2026. In fact, we're down lower before the futures stopped trading. They put limit, suspended futures trading, you know, after limit drop, right after elections. And this is where we are. Let me change this line here. Okay, so there it is. Not rocket science. Now, the pattern here is this. Again, maybe it pulls back a little bit and then hits up there. Very possible. That's it. I'm going to open up the rest of the conversation with you gentlemen, ladies and gentlemen, for any questions you'd like to ask. Any questions. I'm really open to it because it's important that I stop talking and I hear a little bit of what questions you guys might have. You want to look at a stock or anything, I'll do that. So the Q&A session has started right now. Feel free to ask any questions you'd like.
Hey Frank, it's Tom.
Yes, Tom, go ahead, sir. Hello? I'm sorry, I can't hear you. Yeah, remember the VIX is not dynamic per se, so I'm going to be looking at, does anyone know the symbol of the VIX futures by any chance? Because I don't really look at VIX futures. Rip, do you know?
/VX.
I'm sorry, what?
/VX.
Thank you, sir.
Victor X-ray.
Yeah. Thank you, sir. See, something new I learned. What can I say? You're always learning, and this is exactly the point. Thanks, Rip. So here is a chart of the VIX futures right now, and it is like real time, and this speaks volumes. The VIX futures right now collapsed from where we were, and by the way, I did show the VIX. If you look at my repeated VIX charts, I at least put the VIX up at least once or twice a day these days because that's a great proxy to see what's happening, you know, as a inverse correlation, negative correlation with the market. Obviously, that's what the VIX is. And that's what's played out. So the VIX right now has a very flat formation on the 34 and the 50. You guys can see that. And guess what happens? The VIX right now dipped as low as 12.77 when futures were up about 22, 23, has climbed up to right now at, let me put this up here, 1 second, so I can track this one. I'm looking at it on the other side. Right now it's at 1330, right there. If I showed you this chart, most people would not buy it because, you know, it's kind of a negative chart. But then at the same time, this is, 1 second. I apologize completely. This is the close as of Friday. No, it's not. The VIX actually shows the real dynamics on, is the VIX, the VX trading right now, Rip?
Yes, those are futures.
No, I know they're futures. Okay, there we are. Okay, because what happens a lot of the times, Rip, the reason I wasn't sure was because on the daily, the futures don't adjust. It's still the 4-hour move. You know what I'm saying? So this on the VIX actually shows daily. So this is your French. This is right now, Sunday. You know. So what you're seeing, 6 o'clock, markets open. Bang, VIX all the way down to 1208. Now it's starting to stabilize. This looks like a like an earnings fallout, right? That's pretty much what it looks like. You know, you got this big move down, then you got a sharp reversal. I'm not going to read too much into it, but you got a pretty sharp reversal here. And right now, it's basically right there. So the VIX hit 1280 after closing at 14 and change. And given the fact that it's dynamically trading on the daily, you can see that this is what happened, right? Hit here, recaptured, almost recapturing the 50 and the 34 moving average. Now, word of warning, the VIX is a derivative product, right? So what happens is it moves and charts very different than individual stocks. So you get a lot of straight ups, straight down, straight ups, straight downs. All right, it's not like a mild curve up. So don't try to chart the VIX like a normal pattern type of move. However, let's take a look at what it looks like on the weekly basis to give us an idea. And this is where the VIX is. VIX 30 means market's way down. And this type of move down, that means the market's down 400 to 600 points. All right, so now it's here. So what does that tell you? Really not a lot, except that there's very strong support at 11, very strong resistance around 16 and 15, which I already showed. I already showed when the markets were down last week that the VIX hit a level not seen since pre-election. All right, because the VIX hit a level not seen since November, right there, pre-election. That's saying quite a bit. Now, that was a positive divergence. Can somebody tell me why? Why was it a positive divergence that VIX was at 16 plus versus the overall market? Anyone volunteer to answer? Yes, no? Price didn't fall. What price? Scott is close to the answer. What price are you talking about? Yes, that's correct. So Scott does have the right answer. Basically, it was a positive divergence because the markets were way higher, and on a mild consolidation, the VIX basically went berserk and went back to where it was. Markets were here in November, and the VIX had spiked to this level. Markets on a mild consolidation, nothing that crazy, mild consolidation, couple of hundred points, minor, the VIX came to the same level. That's known as a positive divergence. Does everyone understand that? I know, Scott, you do. Great, great, great answer. Thank you, sir. Does everyone understand what a positive divergence is? Is when the indicator, underlying indicator or a proxy is back at the same fear level. This is the way you explain it. Real simple. Traders, retail investors, human investors, gurus out there all panicked to the point where they took the VIX up to the same level as was the case right before the elections when the market was down 9 days in a row and the S&P 500 was down way below. The SPX before during the elections was down at 20,080. I'm sorry, 2,080. On a poll, and here at 20,350 or thereabouts. At this point, it was 16. At this point, it was 16. Yet we were almost 300 points higher, or 270 points higher. We're 270 points higher, but people freaked out the same way on the VIX. Positive divergence. Kind of, you got to take these things into account. And I did mention that too. So looking at the VIX here, Tom's question, I'm going to draw some broad stuff here. Draw a downtrend line from, let's say from here, or from here, whatever the case. Okay, and draw it from here. Unless we break well above 16, we're not going to go hit this downtrend test at 22. The 16 to 22 move will come. Can somebody answer when? If and when it happens. What did I show you where the S&P can go in the month of May? I showed that on the S&P chart very clearly where the pullback could come to. Nope, I never said 2200. 2200? Jeez. Yeah, we could go to 2200. I think she mistyped. K-Bot, did you mistype? Anyway, it doesn't matter. The bottom line is that the 16 to 22 spike will come when we fall in that 2300 level or slightly below. Okay, that's when you're going to get the big fat fear factor rising 22. Anything above 22, market is fully shortable. See you later. Because at that point, it's going to hit 30, 25 and 30. Let's leave it to when it starts happening. Or before we can predict it can happen. So on a broad level, Tom, the VIX is starting, it has a cup here, has a cup, creating a handle, and will most probably break out higher, in my opinion, sometime by mid-May or right after the first week of May. And that is going to be that 20 level that we're talking about, and I think it gets there. Is that a good enough answer?
Yes, thank you.
Okay. Any other quick questions, please? Somebody's got to have a question. You want to look at a stock? I know K-bot Priceline. Yes. So let's look at a picture of Priceline here. And we're going to look at a clean chart, not one of my pre-constructed charts. Here is Priceline. And this is a weekly chart. I'm not even going to look at the weekly. I'm going to just look at the daily. Let's look at the daily. Let's look at some basic chart structures here. We take a trend line here at 1150. We draw it. We extend it. We change the color. Okay. Worst case scenario, Priceline goes to 1650. That's what, roughly 100 points or so from here. Somebody says, no, that can't happen. I say, sure, it can happen. Here's your acceleration channel. You draw it from here, extend it, or you can do this. You can take this line. No, I'd actually keep it here. Or you can do it like that, whichever the case. You're looking at the best contact points that you can find. Change the color. Draw this. Okay, gentlemen. Now we're starting to see a picture here. Priceline, if it stays above the 50-day moving average, again, the good old 50-day moving average, right? The 50-day moving average, that's one thing about old-fashioned technical analysis which never changed. People are fixated on it. It's like the Old Testament. It stays there. The words don't change. All right? So 1730. So below 1730, you start to see a real fall. We can draw a gap fill. Let's do this right. Here's your gap. Bingo. Does everyone see this? So what's the lower end of the gap? Well, pretty much at the same level that that I just showed. One second. There's your actual gap fill. Pretty much at this level. 1641. You need to be a massive buyer of Priceline if it drops 110 points, which percentage-wise is not the end of the world. Stocks at 1752. If we drop 110 divided by 1752, you're talking about a drop of roughly 6.2%. Not the end of the world. So the upper end of the gap, Rip, is upper end of the gap is right here, which is 1699, round figure of 1700. I'll take 1700. 50-day moving average is 1730, which is basically a sneeze for Priceline. It can do that in 5 minutes. Well, not 5 minutes. In 15 minutes and turn around and go up. It's done that so many times before. Or extreme scenario is buy the or a drop of 110 points. 6.2%. Can the stock drop 6.2% on earnings because they have softness on travel because of all these different things? Remember, Priceline is a couple of factors. One is Priceline is not just a travel company, right? It's basically hotel bookings, huge amounts of, they do what B&B type rentals, private rentals, and of course airline tickets and all that stuff. Is it possible that one of them had a weakness? that made them miss their numbers? Sure. Can they give slightly lower guidance? Priceline is notorious for conservative guidance. That means they don't like talking big. They like talking soft and defensive. That's their nature. Okay? They're a very serious company. So they don't, excuse my French, bullshit. So what happens is if they are realistic about some of the stuff, they'll basically lower their expectations a little bit, which they'll blow away next quarter, in my opinion. That's what they've done in their history. So can the stock drop 6%? Absolutely. And then it'll be here. Now, on the other hand, if they deliver the numbers which are better than expected, but more important, the guidance is somewhat strong. And remember, Priceline is one of the only companies out there. No one beats them. It's like the Amazon of the online travel space, right? That's it. Ctrip doesn't come close to it. Expedia doesn't come close to it. Nobody come close to it. Period. They are the big kahuna and the big 800-pound gorilla in the space. If it does, then the stock will basically take out the highs, which they're just around the corner of 1798. 40 points for Priceline, no biggie. Can happen in 5 minutes after hours. 2 minutes. How about 2 seconds if they beat numbers? And here you are, 1800. And once you take out 1800, you have to project how far it can go. So on an immediate move, one can say, oh, it's going to go to 1900. I said to take it easy a little bit. Let's calm our horses. The way I do it is I would draw another line there. It's a couple of contact points. I would say the stock goes to the stock basically goes to 1800, hits some major resistance, and possibly go. 1 second. And I'll show you a trick how you measure where it can go. And I've been pretty right about these type of moves, not just on Priceline. The way you measure it, and I'm sure some of you will remember it. Let's try to zoom in now that we have identified the structures. Okay. What's the size of this range? 1800, 1736. What's the trading range? How many points? Huh?
62 points.
Thank you very much. So if you had to project out how much it can go, you add 62, roughly 62, to the breakout level. That breakout level is not necessarily this. I would make this breakout level here, 1782. All right? So let's look at this trading range, because in reality, that's the trading range Priceline has been trading in, right? So let's do this. 1783 minus 1736. Roughly how much is that? How many points is that? 1736.
47?
Thank you. So you add 47 to 1783. 1783 plus 47. How much is that? 1830. You guys can write this down. 1830. 1830 is right here. Given the breakout of this trading range, which is 47 points, you add that 47 points roughly to 1783. 1783 plus 47 is 1830. On a major earning speed, or whatever the case may be, on a breakout, the stock goes to 1830 and possibly to 1850, which would be basically the lower end of this very powerful acceleration band. When I draw channels like this, the upper end of this channel is the large acceleration channel. Okay, that's when it's just like, oh my God, why didn't I buy it? And every time you say, oh my God, the stock jumps 20 bucks. Every time you don't buy it, it jumps another 25 bucks. That's sort of the massive bear kill zone. Well, the bear kill zone is pretty much here. What's a bear kill zone? That's where the shorts keep on shorting the stock as it moves higher, and they keep on dying. That's a bear, like 100 seasons for the bear. So that's what it is. All right. So that's this zone here. So I would say that on a major earnings beat, the stock goes to 1800 to 1830. On a loss, it tests the lower end of the channel, which is 50 points lower, 1700. I do not think, unless they really screw up on something, that we get to 1640. That's my projection on that. Next stock. How about I suggest one? Amazon. Okay, coming up this week. So looking at the pattern here on Amazon, same old story. Okay, you got, let's look at the simple moving averages. 34-day moving average is 873. The stock can drop to 873 given the fact that there's a large divergence from the moving averages to here, known as standard deviation. So it's moved away quite a bit, just the way it moved away quite a bit here, right? And guess what? It came, almost kissed the 34. Is it possible that it kisses the 34? It can happen 15 minutes after hours, and then they buy the crap out of the stock. They are not going to destroy Amazon, in my opinion, because there is no other Amazon to buy. I've always said this, and I mean it. When the stock was at 840 and dropped down to 720, nobody wanted to touch it whatsoever. It was like a leper colony. You didn't want to go in there, right? Guess what? That was a gift. It's the same story. If the stock comes down to 860, that's 38 points from where we closed at. That is simply retesting the 50-day moving average. If it touches the 50-day moving average, they will, high probability in my opinion, defend it hard. That means big buying opportunity. Does it mean it's going to go back over 900? No. It simply means it's going to bounce from here. And that bounce is good for 15 to 20 points easy. If the stock breaks out, okay? If the stock breaks out, this is a major consolidation channel. If the stock breaks out, there will be no time to buy it. No time to buy it, because it is going to literally, let me draw this. What am I doing? Change the color. There you go. It's a consolidation channel. 7 in the lower end of the consolidation channel is testing the 34 moving average. Nothing wrong with that. In fact, I want that to happen before earnings, which I doubt it will. I hope it does, because that would be a fantastic buying opportunity right there in this zone. I know some traders, emotional traders, are going to freak out. Oh my God, look at Amazon, is down before earnings. Who cares? That's perfect. If it blows up here before earnings and goes to 920, 940, I'll be like, I might short the stock a little bit. Even though that might be a really stupid move. But hey, if you short a little bit, who cares? You don't want the stock to be up 30, 40 points before earnings, period. We want the stock up a little bit so we can trade it during the next couple of days and take some profits and that kind of stuff. But you do not want the stock before earnings to be up 30, 40 points. And if you do, who knows? Maybe the stock's going to $1,000. So let's look to see projection-wise, technically, what might happen. Let's draw some acceleration channels here. I would take this inflection point, draw it like that. That's the uptrend line. Perfect. Okay. It also coincides with the 50-day moving average, give or take, around 860, right? So we're okay with that, guys? Yes, ladies and gentlemen, we're good with that? Everyone understands? Draw a beautiful, this works out beautiful. The right there is your channel. Upper end of the channel, 940. On an earning speed, the stock is going to go to 940. 40 points. Do the math. 40 points divided by 898. You're looking at roughly a move of 4.5%. Can it bust a move over 940? Sure it can. But I'm not going to, venture out there. Can it go to 1,000 immediately? That means you're asking the stock to move 100 points from this 900 level. You're talking about the stock to move 11%. Ain't going to happen after earnings. Sorry. Stocks of that magnitude, large, huge market capitalizations, the law of large numbers, do not move 11%. Only way Amazon ever will move 11% on a 1 to 2 day basis if they split the stock. If they split the stock, God have mercy on the shorts. It'll be up 10%. It'll be sick. But that's an outlier. Let's try to look at this is what we call the megaphone pattern, right? So extend to the right. What are we looking at? If we do the megaphone, 1 second. If we do the megaphone, and this is on a swing basis, which means that in the next couple of months or earlier, never know with these things, the stock is going to go to 990 to 1,000. Somebody might say, hey, the lower end of the megaphone in that case translates out to, look at this. If I draw it, the lower end of the megaphone, the stock's going to 700. I don't think so. I don't think so. Unless North Korea decides to bomb Amazon. It's not going to happen. It is going to be supported around the 860 level. Worst case scenario, around the 820 level if things really blow up, which is the 150-day moving average. Aside from that, these are beautifully upward channeling moving averages. Internals are looking fine. Nothing great, nothing bad. They're looking good. And I'm just looking at the chart structure. Any other stock anyone wants me to look at before I sign off here?
Google.
Sure. So I had this pre-drawn, right, from previous charts that I show. Personally speaking, if Google, given the fact where they are, they actually probably have the highest upside, percentage-wise. Here are the perfect, not perfect, stop using the word perfect. These are the strategic tactical channels that are on Google that one can just trade off, which I've been doing. You have an upwardly trending 5-day moving average right here on the daily, which is very nice, right? You're starting to see the W pattern shaping up on the moving average. Upper end of this second channel, the channels have been drawn to perfection. Believe me, it is. And I did use that word again. So looking at this here, you're looking at 870. That's only 12 points from here. Earnings could drive the stock up to either new highs, which is 890, new all-time highs, or 872, which is from here, only 14 points, right? Yeah, I can. If they want to keep it kind of like kill the premiums on the options and stuff, they can move it for 14 points and basically guys buying 880 calls and stuff, they're just finished. Won't happen. But looking at the wave structure, you can basically see that it probably goes up here. Now, what Google's numbers are going to be, none of us have an idea. How much they lost because of their advertising revenue losses when some of the bigger companies temporarily cancel their ad accounts and stuff. We don't know. So a Google bear will tell you the stock is going down. If it does go down, I would be a buyer of the stock between 825 to 840, which I think, in my opinion, is going to be the support. That's also the 150-day moving average. Google also has no alternative. Big fund managers who buy Google can't find another Google to buy. Give me another Google to buy, they'll dump this stock and buy that one. There is none. Just like Amazon, there is no direct comparable. That's how fund managers think. Remember that. So bottom line is, you got the 880 level in play. 820 to 840 would be the initial drop if things really are bad. Anything below 820, Google becomes a confirmed short all the way down to 760, right here. That's only if it breaks below, convincingly breaks below this magenta line, which is the 150-day moving average on the daily. You could short Google, buy a nice month out or 2 months out, because it's going to fall at that point, and it could be very fast, and that would become a phenomenal buying opportunity if that happens. Aside from that, 840 moving the 34 and the 50-day moving averages are right there around the corner at 850. I think it's a pretty good trade. It's a pretty good trade on the upside. And so far so good on the internals, so we're good to go. What else?
Tesla.
Tesla going to the moon. Just kidding. Tesla's going higher in my opinion. Oh yeah, look at this chart. It's sick. I mean, every time I look at it, and I actually haven't seen this, I don't look at the daily charts that often. I mean, it's just like, and I don't even like Teslas, like I keep on saying. This is a damn good looking chart. It's bull flag after bull flag, massive cup breakout. I mean, I don't know. I'll tell you what I know. Internals, positive. Just looking at full stochastics, not even getting into deep down dirty internals. Not a dirty martini here, okay? Just simple internals, full stochastics. Looking fine. This is the daily, so it cuts out a lot of the daily monkey on a hot tin roof type of noise. What does this pattern look like right here after this big move? What does this look like? Can somebody tell me?
Pennant.
Yes, and what type of pennant?
Bull pennant.
Yeah, a bull pennant, a bull flag. Correct. Right there. There was that one sell day. Everyone's like, oh, short Tesla. Come on, relax. We actually shorted it. We did okay. I wish I shorted more. I'm scared to short Tesla. With a 26 to 27% short interest by the likes of some big shot fund managers and stuff, you think I'm going to go short? They're getting killed. So Tesla's best to be played on the long side. Bottom line is, here's a pennant. If this pennant breaks out, you are looking at 330, upper end of this channel, retest of the mid channel. Let's look at the bull case first. And the upper end of the channel, 360. Both are possible. Both are possible. If Tesla moves 5% from here, that's 5% is basically only $15, right? 10% is $30, which would bring it up to here. Will it get up to 360 right away after earnings? No, I don't think so. That's asking. It's like crazy, but it's crazy. I mean, it's a swing trade. But after earnings or whatever, I think the stock does hit 330. Lower end of the picture, we have something extremely positive going on. Can somebody see it and tell me what it is? Aside from Rip or somebody.
The task.
Huh? The what?
Task crossover.
What crossover?
Slow stock.
Where are you seeing a slow? Where are you seeing a slow stock crossover? This is the stochastics down here. Is this what you're talking about? I think you're looking at the right thing, but naming it differently. This is not what you're looking at, right? When you said
I was looking at that. Yeah,
you're looking.
Cross.
Oh, this is about to cross. That's what you just said.
Right.
Okay, that's good. That's not what caught my eye right away. In fact, I'm seeing this for the first time. Not the first time, but you know. Look at in this zone here. What is going on that's extremely positive? That happened, I'll give you a clue. That happened last December. I need some intelligent answers. And I'll be called by name. Don't mind. K-Bot, can you spot it? And I already gave the clue. This happened back in January of this year. Okay. She already gave the answer. Another fantastic ACS student. Great. She already gave that. The 34 crossed the 50. Right there. Will you get these 34.50 crossovers? You better get the heck out of Dodge if you're seriously thinking of putting your hard-earned money on the short side of Tesla. Doesn't mean you can short it intraday for quick 5, 6, 7 points. I'm talking about a swing trade. You get a 34.50 cross Last time you got a 3450 cross, ladies and gentlemen. Remember, these are long-term crosses, right? 34-day moving average, 50-day moving average. You're not talking 5-minute, 1 hour, 15-minute, like all of us monkeys on a hot tin roof try to trade during the day. I'm talking real longer-term crossovers. Thank you for the answer. So the 3450, the last time it was 3450 crossover, the stock was at 210. You got the same 3450 crossover when the stock's at 295. And these idiots on TV still want to short the crap out of the stock? Really, it's like amazing. These technicals are telling you that there's some serious stuff going on. I'm not saying it's going up 100 points. I'm simply saying the probability of the stock moving into that 330s range or so is pretty high. Given this, just one thing. What else is happening here? Great answer. Thank you, KBot. So great answer here. So this is be careful when you see 3450 crossovers or cross unders, crossover downs. Beware. Once you get crossover down, the stock, yeah, it zigzagged around, but it's this keeps on falling and keeps on becoming massive resistance. This now is massive support. So even if it drops 20 points, this keeps on moving up, you buy it because this has now got real intermediate to long-term momentum. Does everyone understand that part? It's simple stuff. This is not rocket science. I'm not like some technical genius here. I'm just looking at some very powerful, simple ways of looking at things. Now, there is something going on which is overvaluation. Can somebody tell me what it is? Okay, here's the answer. The standard deviation or the distance traveled from the moving averages, right, to where the stock is right now, it's not excessive, but it's kind of high. And normally when it gets up towards those levels, there is a corrective phase. So that's the bear case, that the stock could come and test 290, 280, 290, or the lower end of this channel on a earnings pullback, and then you buy it. Okay, so the standard deviation or the distance between the moving averages and where we are right now, I would say it's a standard deviation. Looking at it quickly, is probably about 2 or 3, nothing excessive. But the standard deviation from the 150-day moving average is quite wide. So in order to see what it's historically done on these type of standard deviations, let's revert back to the weekly chart that goes back 3 years. And this is pretty overvalued in the sense that here's the 150-day moving average, and there's the stock. Everything else fits right, but that from a valuation standpoint is pretty substantial. So I would say that within this zone, if the stock gets there, it's pretty much fully valued for that time without knowing every little detail on Tesla's internal fundamentals and stuff. Does everyone understand that? You have a 3450 crossover here. You got this thing moving, going towards the upper end of the channel. Structure-wise, very bullish. Wave 1, consolidation wave. Wave 2, wave 3. Wave 3 could possibly take us here, creating wave 4, which is a pullback. Remember, everything moves in 5 waves. A pullback, and then wave 5 takes it higher. So we are basically right now on that wave 3. Wave 1, wave 2, wave 3. We're not, wave 4 is the pullback mode. Maybe that's when Model 3, what is it? What's coming out in September? I mean, the semis, they're going to announce it, but what else is the other one? Model 3? I don't know Tesla's that well. Model X? What is it, guys? Is it?
The Model 3 comes out this summer. They have the semis.
Okay, so semis
coming out in September.
So basically, if you think about it, Model 3 comes out, so that could be the pullback wave. Model 3 comes out, the semis come out, and the semi can't, it puts in a heavy payload, and the car and all the batteries run out of charge. Hey, you never know, right? Whatever the case may be. So that could be that pullback mode, for all I know. So that's really how it plays out. But this is a very bullish chart, and this would be the points of maximum, sort of the sell zones. And if we do bust a move, which is really, really big, then this is the most you can get out of it. But this is pretty overvalued when you look at the moving averages and the standard deviations from here on a weekly basis. So again, it's a tactical play. On a shorter term basis, you got a good amount of points, but optimally speaking, if the stock does pull back, let's say 10 or 15 points or 20 points before earnings, then there's a minor gap here. It's pretty damn good. So on that note, guys, I do have to run. It's 9:22. I think it was a fantastic session. Thank you for attending. This will be recorded and uploaded to the YouTube channel within the next hour. Look forward to seeing you guys tomorrow. Futures are still up 19. People who are long on some of the trades that they did and listened to my alerts and did whatever they need to do are going to be well rewarded. Do sell at the open, okay? And in the meantime, I'll engage with you guys tomorrow. Thank you for being here, and thank you for all the support.
Thank you.